There's a chart Wall Street won't talk about. It's called the Buffett Indicator. Right now, 206% of GDP. That's higher than before the dot-com crash, higher than 2008, higher than any point in recorded history. Translation: the stock market is worth twice what the entire U.S. economy actually produces. That's not a sign of strength. That's a red flag the size of Texas. Here's what nobody's telling you. This has happened before, 3 times in the last century. And every single time, what came next was a collapse of at least 40%. Not a dip, not a correction, a collapse. Let me show you exactly what's coming. Market crashes aren't random. They follow a script, the same script every time. Think about it. 1929, 2000, 2008. Different decades, different triggers, but identical warning signs before each one. Sign 1. Everyone's a genius. Your barber's giving stock tips. Reddit's got investment advice. TikTok's teaching day trading. When the guy delivering your pizza starts talking about his portfolio, the end is close. Sign 2. Valuations go insane. In 1929, stocks hit 30 times earnings right before the crash. In 2000, companies with no revenue were valued in the billions. Today, the Shiller P/E ratio just crossed 35. That's only happened 3 times. You know what happened next? All 3 times? Complete obliteration. Sign 3. Debt everywhere. In 2007, banks gave mortgages to people with literally no income. They called them ninja loans. No income, no job, no assets. And somehow that seemed fine until it wasn't. Right now, margin debt just hit $900 billion. That's an all-time record. People are borrowing almost $1 trillion to buy stocks they think can't go down. But here's the uncomfortable truth. We're out of ammunition. In 1929, interest rates were 6%. The Fed could slash them to save the economy. In 2008, government debt was 64% of GDP, manageable enough to spend trillions on bailouts. Today, rates have been near zero for over a decade. Government debt is 130% of GDP. We're already drowning in $33 trillion of debt. So when the next crash hits, and it will, what saves us? Nothing. Let me walk you through exactly where we are right now. The stock market keeps hitting all-time highs. Sounds good, right? Except corporate earnings are stalling, productivity's declining, economic indicators are flashing red. So why are stocks going up? Because there's literally nowhere else to put money. Bonds pay nothing. Savings accounts give you 0.5% while inflation runs at 4%. Real estate in New York, San Francisco, Toronto, Vancouver, absurdly overpriced, so everyone piles into stocks, which pushes prices higher, which attracts more buyers, which pushes prices higher. It's a feedback loop, and feedback loops don't stop. They explode. Here's how leverage kills you. Say you borrow $100,000 to invest. The market goes up 20%. You pay back the loan and pocket $20,000. Feels like magic. But when the market drops 10% and you're leveraged 2 to 1, you don't lose 10%. You lose 20%. Drop 20%, you get a margin call. You're forced to sell, which drops prices more, which triggers more margin calls, which forces more selling. October 1929. That's exactly what happened. Margin calls created a death spiral that erased 89% of the market over 3 years. Not a crash, an extinction event, and we're more leveraged now than we were then. Want to know how insane things are? GameStop traded at 100 times sales. JPEG images sold for millions of dollars. Companies with no product went public through SPACs. A cryptocurrency named after a dog hit an $80 billion market cap. When garbage outperforms quality, the casino's about to close. And everyone knows it. The Fed knows, the Bank of Canada knows, fund managers know. But stopping a bubble means pain. It means raising rates and causing a recession on purpose. No politician wants to be blamed for that. So they keep printing money. A little more stimulus, just a bit longer. Until they can't anymore. You can't predict What triggers the crash? Could be China's real estate market collapsing, could be a European debt default, could be a cyber attack on financial systems. But here's what matters. The trigger isn't the cause, it's the excuse. 1929 wasn't caused by one bad day in October. It was caused by a decade of reckless speculation on borrowed money. The system was a house of cards. It just needed a breeze. 2008 wasn't caused by Lehman Brothers failing on September 15th. Lehman was a symptom. The disease was 10 years of giving mortgages to people who couldn't pay, packaging those bad loans, calling them safe, and selling them to pension funds. The next crash won't be caused by whatever headline CNN blames. It'll be caused by what's broken right now: valuations detached from reality, unsustainable debt, and a market propped up by money printing instead of growth. When it breaks, here's what happens. 4 phases every time. Phase 1, denial. Market drops 10%. Everyone says it's healthy. Just a correction. Buy the dip. Great opportunity. Prices stabilize. Everyone relaxes. Phase 2, realization. Something else breaks. A major fund collapses. A country defaults. More bad data drops. The narrative shifts from buying opportunity to genuine concern. Fear replaces greed. Phase 3, cascade. This is the kill zone. Margin calls accelerate. Forced selling begins. Liquidity evaporates. The market doesn't fall gradually. It gaps down violently. Circuit breakers trigger. Trading halts. Everyone runs for the exit at once. And that's when you realize the exit is tiny and you're not getting out. 2008, the S&P fell 20% in 2 weeks. March 2020, down 34% in 23 days. That's not a slide, that's free fall. Phase 4, intervention. Central banks panic. Emergency measures get announced. Massive stimulus gets promised. Sometimes it works, sometimes it doesn't. In 1929, it didn't. The market fell for 3 straight years, down 89% by 1932. And here's what should terrify you. If the next crash happens while rates are already at zero and debt's already at crisis levels, the playbook doesn't work. You can't cut rates from 0 to -5. You can't borrow infinity when you're already drowning. The tools are gone, the ammunition's spent. Let's talk about what happens after. Because this is where the real damage occurs. Markets always recover eventually. They have to. But the societal scars last for generations. After 1929, it took 25 years for the market to recover. 25 years. An entire generation lost everything. Wealth inequality exploded. Political extremism spread. The world went to war. After 2008, the market recovered by 2013. Sounds better, right? Except it only recovered because central banks printed $15 trillion. And that money went to people who already owned assets. Own stocks and real estate? You got rich. Don't own assets? You got left behind. The wealth gap today is wider than it's been in a century. And after the next crash, same pattern, but worse. Because the tools are weaker, the safety nets are thinner. And the people who'll get destroyed are the ones who can't afford it. Here's the math nobody wants to face. You're wealthy with a $5 million portfolio. Market crashes 40%. You're down to $3 million. It hurts, but you don't sell, you wait. 5 years later, you're even. 10 years later, you're ahead. You're not wealthy. You've got $100,000 in your 401k. That's your entire retirement. Market crashes 40%. You're down to $60,000. Then you lose your job. You need money now to pay your mortgage, feed your family, so you sell at the bottom. You lock in the loss. Permanently, you never recover. You never get back in. And the gap between you and the wealthy just became permanent. Crashes don't destroy wealth. They transfer it from the unprepared to the prepared, from the desperate to the patient, from the middle class to the rich. Every single time, every major crisis forces structural change. After 1929, New Deal, Social Security, FDIC, SEC, Glass-Steagall. After 2008, Dodd-Frank, permanent quantitative easing, negative rates, complete monetary policy transformation. The next crash will force change too. Digital currencies, universal basic income, complete financial system redesign, something we haven't even thought of yet. But change only comes after pain. And the people saying, let's prevent this, get ignored. Because prevention is boring. Prevention requires sacrifice now for safety later. Politicians can't sell that. So the bubble keeps growing, the warnings keep flashing, and everyone pretends this time is different, except it's never different. The details change, the assets change, the stories change, but the pattern is identical. Speculation, leverage, mania, crash, repeat, always. The only question is when, and history can't tell us that. Some crashes are instant. 1987, down 22.6% in one day. Others are slow. The dot-com bubble took 30 months to bottom out, but they all happen. Every bubble pops, every time. And right now, every indicator says we're closer to the crash than the peak. The question isn't if, it's when. So what do? Wrong question, real question. What are you willing to give up today to survive tomorrow? Because preparation costs you. Holding cash while stocks rally 20%, missing the final stage of the party, looking foolish while your friends make money. Until you don't look foolish anymore. Most people won't prepare. They'll stay invested, convinced they'll see it coming, convinced they'll get out in time, convinced they're smarter than the market. They're wrong. Statistically, almost all of them will be wrong. History doesn't repeat exactly. But it rhymes, and right now it's rhyming loud. The crash is coming, not because I say so, because the math says so, because every bubble in history has popped, because trees don't grow to the sky, because gravity always wins.
The only mystery is what it looks like when it does. But one thing's certain, when it comes, it'll be fast, it'll be violent, and most people won't be ready, will you?